Hello everyone, this is Christian Doetsch, and you're listening to Beat the Market Episode 3 on Doetsch Money. Today, we're going to have our regular portfolio update with our existing holdings, including a big reveal of our third stock choice. I got a lot of positive feedback from my channel viewers about the Disney business analysis from Episode 2 last week, so the second half of this episode will be the same type of analysis, but for Delta Airlines. Let's get started. The portfolio update is going to give away our third choice, so I'm actually going to reveal that before we look at this week's account summary. This company has been an incredible short-term play for me in the last 18 months, and I anticipate that with continued uncertainty and volatility in the market surrounding the Delta variant and future COVID variants, this position could be valuable as both a short-term flip and a potential long-term holding. It's my favorite company of all of the cruise line companies, and that's Royal Caribbean. We put in a little over $500 to start out with, but we'll be adding to this holding until it gets to be around $2,000. Don't be fooled by all of the green that you're seeing on this screen. The color on this screen just indicates how well it did Friday at closing, but unfortunately, the rest of the week was an absolute bloodbath. We went from being up about $150 total to being down over $200 total. If we were short-term traders, this sort of loss would be pretty brutal. But since we're trading with a 2 to 3 year outlook, the short-term market volatility doesn't impact our overall strategy. It's almost better when the market is down in the short term because it means you can buy more shares for the same amount of money. The entire market was down last week, so we lost out in every position except our small holding in Royal Caribbean. VT Sachs and Disney dropped a bit last week, but Delta did exceptionally poorly due to more sustained worries about the future of air travel related to COVID-19. Royal Caribbean did drop early in the week, but I was able to buy it at a good time, which is why it still has a small gain. At the end of week 3, our index fund, with a gain of $76, continues to be ahead of our stock portfolio, which, after a rough week, is currently at a net $224 loss. That's the portfolio update for the week. So now let's talk about Delta Airlines, my favorite airline company, both for personal use and as an investment. After Delta's 2007 bankruptcy and subsequent restructuring, they grew to be the largest airline carrier in the world by number of passengers until American Airlines merged with US Airways in 2015 and surpassed them. Since then, Delta and American have been fighting for the number one spot for number of passengers, even though Delta has consistently more revenue and much more profit. Historically, United Airlines and American Airlines have been Delta's largest competitors in the US, and all three of them are considered legacy carriers because they existed in the US before the industry deregulation in the late 70s. Since then, Southwest has actually been the most successful new airline in North America and has a better market cap than Delta does right now. Domestic air travel has recovered quite a bit, but international travel is still struggling. Southwest's routes are primarily domestic, while Delta has a much higher proportion of international travel, so it makes sense that Southwest is getting back to their pre-pandemic market cap faster than Delta is. The biggest risk of buying Delta is the same as the risks to buying any of the other airlines, and that risk is the potential for COVID to permanently impact air travel. It's important to keep in mind that the stock price isn't low because we have COVID now, and it's not really even because we have worse COVID now. The price is low because of the variant, which implies the possibility of future variants, which also implies a reasonable chance that expenses and lost revenue become a permanent part of the industry, and not just a temporary setback. Remember, the price of a stock isn't really about what the business is doing right now, but instead takes into account the projected future earnings and value of the company. One thing that Delta has in common with the other two stock choices is a high sensitivity to COVID. I did this intentionally because it's my opinion that uncertainty in the market is overstated as a result of human cognitive biases. Michael Lewis, an author best known for Moneyball and The Big Short, has a fascinating book about this topic called The Undoing Project that covers all sorts of cognitive biases that people have. There are plenty that I'm sure you've heard of, like confirmation bias or sunk cost, but a less known bias is at play at the market, and it's called loss aversion. Let's say you get to choose between two prizes. Option A is a guaranteed $1,000, and option B is a 70% chance of $1,480, but a 30% chance of $0. The loss aversion bias will make most people pick option A, even though mathematically option 2 has a higher value. When the $1,000 is guaranteed, choosing option B is akin to losing $1,000 that you already have, and the loss aversion bias states that the fear of the $1,000 loss is stronger emotionally than the gain of $1,480. Even with concrete percentages and calculatable values like the two prizes, many people would still pick the less valuable option. In the stock market, we don't have concrete percentages and values like that, so the possible risks and possible rewards are difficult to estimate. This is why plenty of people take a guaranteed 1.3% with US Treasury bonds rather than risk it with a stock that yields a 2% dividend but has a chance of dropping in value. The fact that I'm a long-term trader means that I can place aggressive bets in the face of uncertainty by holding risky positions. Delta, Disney, and Royal Caribbean are all stocks that people are selling at a discount due to fears and uncertainty caused by COVID-19. If I'm right, and the world recovers better than the market thinks it will, our bets will pay off. If I'm wrong, and COVID continues for the next 2 or 3 years, or gets worse, the stock half of our portfolio will suffer. Those are the two extremes, and the most likely outcome is probably somewhere in the middle. Now, some of you may have noticed a pattern with these 3 stock choices, and I have a bias that I need to point out to you. The 3 stocks in our portfolio so far are all companies that I'm very familiar with as a consumer. For casual investing, like what we're doing for this show, it's perfectly acceptable to stick with companies that you actually use in your life, especially if your interest in the company results in a better understanding of the business or the industry. With that in mind, it's also important that I account for this bias in the analysis and make sure that my personal love for these companies doesn't fog my analytical judgment and valuation of the business. We started talking about Delta this week and spent some time talking about cognitive bias and uncertainty in the market as well. I have more to say about Delta as a stock pick, but I need some more time to do some research, so we'll continue with that next week, and we'll also cover a bit about Royal Caribbean and some attractive properties that Royal Caribbean shares with Delta. Thank you all for listening to episode 3 of Beat the Market. Have a great week.